Hello, guys. I hope everybody is doing good today. This is going to be another one of my trading concepts video where I kind of talk about some of the things that I've learned, in the market. On the previous video, I talked about what's the difference between trading and gambling, right? And why you want to make sure that you have your data because you don't want to be a gambler, you want to be a trader. If you want to be a trader, you need to have your statistics, right? Because once you have your statistics, you can improve, become better, right? Because if you're gambling, you're just living on opium. You're an addict, right? You just putting money into the market, hoping for things to happen. You're an emotional roller coaster. You do not want to do that. You want to be a trader, act like a trader, and know your statistics, right? Okay, so if you just started trading and you want to, do things the right way, have your statistics, the first few statistics that you need to have, again, you want to be simple, you want to get started. There's really three statistics to me that you need to know at first, right? So you want to know your win rate, which is a measure of how often you win and how often you lose, right? So you want to know that. You want to know your risk reward ratio. Your risk reward ratio basically tells you, okay, whenever I win. My wins are that much bigger than my losses. So if you have a risk reward ratio of 2, then every time you win, your wins are twice as big as your losses, right? So you win $200, you lose $100, right? And once you have your win rate and your risk reward ratio, then you can move on and find out what your expectancy is, right? You hear traders talk about they have edge in the market, right? Edge basically means that over a long period of time and multiple trades, you will end up making money, right? Edge means that you have a positive expectancy. And on the other hand, if you have a negative expectancy, my friend, you should change your strategy. That's why you want to know these data, right? You want to make sure that you have this data ready. Whether backtesting a strategy. Backtesting means you go back getting data from the past to figure out if your strategy works. Or you forward testing. Forward testing means that you take a strategy, you actually applying it to the live market, and then you get data for your strategy and then to compute some of these statistics, right? So I have an example here, very simple example. You took 10 trades, you have 5 wins, 5 losses, so your win rate is basically 50%, right? Your losing rate is going to be 100 minus your win rate, which is also 50% in that case, right? Your risk reward ratio, I took a couple of trades. Let's say on first trade you made 1,000, second trade 1,000, third trade 1,000, fourth trade another 1,000, and then the last one 900, right? You divide it by 5 after you added it up, and then you have $980 is your average win, right? You do the same thing, you calculate your average loss, right? Your average loss is going to be the sum of all your losses divided by the number of losses. In this case, 5 losses, it gives you 780. From that point, you can calculate. Sorry, there's a typo. You can calculate your risk reward ratio. In this case, it would be 980 divided by 780, which will give you 1.25, right? That's what your win is 1.25 bigger than your loss. And then once you have that, you can compute your expectancy, right? Your expectancy would be your average win, which is 980, times 0.5, which is your win rate, minus your average loss, which is 780, times your losing rate, which is 50% of 0.5, right? And then you get 100. So 100 is your expectancy. Your expectancy every time you take a trade over a long period of time is going to be to make $100 every trade. So if you take 20 trades, at the end of the 20 trade, you should expect to have $2,000. All right. So why is that important? Well, it's very important to know because if I have a positive expectancy, right, then I'm going into the market expecting to make money. That's why it's called expectancy, right? And you go with that positive attitude because you have this data, that's backing you up and that you know has shown that your strategy actually makes money. Let's just say you go trading and you don't have any data. You just go out there hoping, right? And you're losing money for a period of time, right? Well, does that mean your strategy doesn't make money? Not necessarily, right? Because as we know, statistics, play out in the distribution of wins and losses is not necessarily something that determines if you're going to make money or not. It could be random, right? So what you want to do is you want to have this data ready before you apply your strategy to the real market, so you know what's going on, right? And another thing to keep in mind is that actually most of the time, right, strategies actually have expectancy dependent on market conditions, right? So if you take a trending strategy, for example, is adapted from when the market goes into one direction. That's what you call a trending market, either a bull market or bear market, right? And if you apply a trending strategy to this market, you will get a positive expectancy if you have a good strategy, right? Now, if you take that same exact strategy that has an expectancy, a positive expectancy, and you apply it to a ranging market. A ranging market is a market where the market really goes nowhere. It's in ranges between two prices. So typically a trending strategy would not do as well in that type of market. Actually, sometimes you will actually end up with a negative expectancy, right? Now, does that mean that your strategy just doesn't work? No, that's not what it means. It just means that strategy is not adapted for that type of market. So what you should do, that means you have to have different strategy for different markets, right? And that's why these statistics are very important, because those statistics give you an idea of what your strategy is like, right? Your strategy is like a friend, right? When you have a friend, you know the good things about your friend, you know the bad things about your friend. That doesn't mean that it's a bad friend. It just means that you have to know, how that friend can help you, how you can help them. So characteristics of your strategy also sometimes function the same way. And the characteristic of your strategies are the statistics of your strategy. So that's why you gotta know your statistics, right? So what do you do if you have a strategy that has a negative expectancy? You throw it in the trash and you get a different strategy, right? Especially if it's over, many different type of markets, right? Typically, I like to check my strategy against different types of market to make sure that, my strategy is not biased to a certain market. If it is, then I just like to know, and I try to apply that strategy only in that type of market, right? So yeah, this is just going to be a quick video, just sharing some of the statistics that I think are really important to trading. So, whether you back testing your strategy, going back, getting data to know the statistic of your trading strategy, or you forward testing on the market and getting data to get your statistics, make sure you get that done, get your statistics, get your expectancy, to make sure that you have a strategy that has an edge. And once you do that, you're on your way to becoming a successful trader. Thank you guys for watching, and I really hope that those videos are helping people. That the trading world can be a little bit lonely sometimes, and you can kind of feel stuck. So sometimes just a small idea or small principle can really make the difference. So thank you guys for watching. Subscribe, comment, let me know what type of topic y'all want me to cover, and see you on the next video.